Welcome to the deep dive. Today, we're diving into the world of backtesting.
Oh, cool.
It's a way to test out your trading strategies, but using historical data before you risk any real money.
Yeah, that makes sense.
You know, you actually sent over some really fascinating material for this.
Oh, yeah?
Yeah, it's a bunch of transcribed lectures from I think he's a professor in Thailand who is like a trading expert, and he teaches on this subject.
Wow.
So I'm really excited to kind of dig into this with you and see what kind of unique perspectives we can uncover.
Yeah, I've skimmed through some of the material, and he seems to have a very hands-on practical approach.
Okay.
You know, he really stresses not just the technical parts of backtesting, but also the psychology of it and like the limitations of it.
Yeah, well, he starts out the lecture explaining what backtesting is and why it's so important for traders.
Right.
And he makes it very clear that it's not just about seeing if a strategy made money in the past.
No, it's more about understanding the potential risks and rewards. Like how it would have behaved in different market conditions.
Right.
Almost like a dress rehearsal for your trading plan.
Exactly. And, he goes through all sorts of different methods like single back tests, simulations, walk-forward analysis.
Oh, wow.
He even talks about something called a monkey test. So it's a whole arsenal of tools that you can use to evaluate your strategies.
And it sounds like he's very clear on like when to use what tool and why.
Right.
Because he really highlights the limitations of just doing a single back test, which just gives you a snapshot of past performance, right?
Yeah.
That might not be reliable, especially in like a dynamic market.
Right, and that's where simulation comes in.
Right.
And he uses this really cool analogy. He describes the system as 4 plus B,
Okay.
where 4 represents your core strategy,
Yeah.
and B is this random variable.
Interesting.
And so this B factor is really key because it injects this like randomness into the simulation, which mimics the unpredictable nature of the markets.
Yeah, because the market's not just going to do what it did last time.
Exactly.
Yeah.
And by running all these simulations with different random variables, you get a much more realistic picture of how your strategy might actually perform, in the wild.
I love that analogy.
Yeah, I thought it was cool too.
Yeah.
And he also goes into like the essential metrics for interpreting your backtesting results.
Okay.
So things like compound return, max drawdown, exposure.
Right, the important ones.
Yeah, so it gives you this quantitative framework for evaluating how well your strategy is actually doing.
Makes sense.
And this is where it gets really interesting. So he's very skeptical of certain backtesting practices like page shuffling.
Oh, really? What's that?
So page shuffling is where you basically take your historical data and you just rearrange the sequence of trades to create a larger sample size for testing.
Okay.
But he sees this as a form of cheating because it disregards like the dependencies within market data.
So like in real markets, trades are not independent events. They happen in a specific order.
Exactly. It's like if you took a novel and just shuffled all the pages, you'd get a completely different story.
And it wouldn't make any sense.
Exactly.
So he doesn't like that.
No, he does not like page shuffling.
So what does he say to do instead?
So he advocates for a method called Monte Carlo simulation, which basically generates multiple hypothetical scenarios. But they're based on the statistical properties of your historical data.
Gotcha.
So it's a much more robust way to actually test how resilient your strategy is. And to understand like the range of outcomes you could expect.
Yeah, that makes a lot more sense.
And he also has like strong opinions of something called the monkey test.
The monkey test, what is that?
Yeah, so the monkey test is comparing your strategy's performance to that of a random trader.
Oh, like they're just buying and selling randomly?
Right, like a monkey throwing darts at a stock board.
Okay.
But the caveat here, and this is really important, is that the monkey trader needs to operate under the same constraints as your strategy.
Oh, so it's like a level playing field.
Exactly. So same market conditions, same stock selection criteria, everything.
I see.
So you're making sure that your strategy actually has an edge and it's not just luck.
That makes a lot more sense, because when you first said monkey test, I was picturing a monkey at a computer trip.
I know, right? It sounds a little crazy.
Yeah.
But it's actually a pretty sophisticated way to really understand if your strategy is working.
Yeah.
So we've talked about the different methods, some of the pitfalls to avoid. What else stood out to you?
I really liked his emphasis on transparency and personal accountability.
Okay.
He actually recommends creating what he calls a personalized matrix, which is a set of criteria tailored to your specific goals, risk tolerance, and your market understanding.
So it's not about following like these generic metrics or industry standards.
Right, because he says relying on just like these predefined benchmarks can be really misleading.
Okay.
He encourages you to define what success means for you.
Got it.
Based on your specific situation.
Okay, so tell me more about this matrix idea.
So like it could include your maximum acceptable drawdown, your target return on investment, your preferred holding period.
Okay.
It's really all the factors that are specific to your style of trading.
Yeah, that's great.
The point is to move beyond these like cookie cutter approaches and to develop a framework that reflects what you actually want to achieve.
And I think that's a really powerful concept.
Oh, yeah.
It's about taking ownership of the whole process.
Absolutely.
And making sure that it works for you.
Exactly.
Yeah, and it's preventing you from falling into some of those common pitfalls.
Yeah.
And I'm already starting to see how his approach can help people develop more robust strategies.
Oh, for sure. And we've just scratched the surface here.
Yeah, there's a lot more to cover.
Yeah.
So why don't we take a little break?
Okay.
And we'll come back and we'll explore some more of his unique insights.
Sounds good.
We'll talk about walk-forward analysis and then this really cool thing called random walk-forward analysis.
Oh, I'm intrigued.
Yeah, and then we'll also talk about his views on data selection, and especially when it comes to the Thai stock market.
Okay, cool.
So stay tuned. Welcome back to our deep dive into backtesting.
Yeah, it's really interesting stuff.
It is. We were talking about that personalized matrix idea last time.
Yeah.
It really emphasizes like making sure that your backtesting criteria is suited to your own goals and your own risk tolerance.
Absolutely. You really got to take ownership of that whole process and not just rely on some generic metrics.
Right, exactly.
That might not be relevant to you.
So he talks about some more specific techniques too.
Okay.
One that caught my eye was walk-forward analysis.
Oh, yeah.
Have you heard of that before?
Yeah, a little bit. It's basically simulating how your strategy would have performed over time.
Right.
As if you were actually trading it.
Okay, so you break down the historical period into smaller segments and test on each segment.
Right. So instead of looking at like the whole thing from 2000 to 2020, you break it up maybe 2010 to 2012, 2013 to 2015, and so on.
Yeah, you're basically moving forward in time step by step to see how it adapts.
Right, because the market conditions change so much over time.
Exactly.
This way you can see if your strategy is consistent or if it was just lucky during a certain period.
That makes a lot of sense. And then there's something called random walk-forward analysis.
Yeah, that one's a bit more complex.
Yeah.
It's still walk-forward analysis.
Okay.
But instead of just going like linearly through time, you kind of select random starting points and durations.
Interesting.
So you might test like from 2008 for 2 years.
Oh, okay.
And then randomly jump to 2014 and test for 3 years.
Okay, so it's more random.
Yeah, it helps to reduce the risk of overfitting because you're not just tailoring it to one specific period.
It's like mixing things up a bit.
Exactly.
So you get a more well-rounded picture.
Right. You want to make sure that your strategy is robust.
Exactly. And of course, he has a lot of opinions about certain practices.
Oh, yeah. He's not shy.
No, he is not.
About sharing his opinions.
We talked about page shuffling last time. He also doesn't like something called in-sample bug testing.
Yeah, what's that?
So that's when you basically train and test your strategy on the same data.
Oh, so you're kind of cheating.
Right, like if you were studying for a test and you use the actual test questions.
Yeah, you'd get 100%, but you wouldn't have learned anything.
Right, exactly. And so your strategy might look great in backtesting.
Yeah.
But then when you go to use it in the real world,
it fails.
It fails. So he really stresses that you need to separate your data.
Okay.
You have your in-sample data, that's for developing your strategy.
Okay.
And then you have your out-of-sample data.
Right.
And that's the one you use to test it.
So it's like practice versus game time.
Exactly.
You practice with one set of data, and then you see how you perform with a completely new set.
Right. And it's about making sure that your strategy is actually working.
Yeah, not just that it looks good.
And he says you should resist the temptation to tweak your strategy to fit the out-of-sample data.
You can't cheat.
Because that's just another form of cheating. It's like moving the goalpost after you've already kicked the ball.
Exactly.
You're not really getting an accurate picture.
So honesty and discipline are key.
Yeah, they're just as important in backtesting as they are in actual trading.
That's a good point.
And he advocates for like keeping detailed records of everything.
Oh, really?
Yeah, so your methodology, your assumptions, your results, so that someone else could come in and look at it.
Oh, so they can audit it.
Exactly. It's like a scientific experiment.
You need to be able to replicate the results.
It makes your conclusions more valid.
I like that a lot.
Yeah, I thought that was a really interesting point.
Mm.
And he also talks about the need to incorporate like real-world factors.
Okay, like what?
So things like transaction costs, slippage.
Right, because those can eat into your profits.
Exactly. Like if you're going on a road trip and you forget to factor in gas.
Yeah, you might get there, but you'll be broke.
Exactly.
And slippage can be a big one, especially in volatile markets or illiquid assets.
And he says a lot of platforms don't account for that.
Oh, so you could get overly optimistic results.
Exactly. So it's important to be aware of those limitations.
Yeah, don't get ahead of yourself.
And then he gets into like the Thai stock market.
Okay, this is where it gets interesting.
It does. Because he says you can't just use any data set.
Okay.
You have to understand the nuances of it.
So like what's different about the Thai stock market?
Well, he gives this example of the SET50 index, which is like their benchmark index.
Yeah.
And he says that the composition has changed over time.
Oh, like companies have been added and removed?
Exactly. So if you're not accounting for those changes, your results could be misleading.
It's like trying to analyze a basketball team based on their roster from 10 years ago.
Right. The players are different. The game's different.
You're not going to get an accurate picture.
So he emphasizes using data that is accurate for the time period you're interested in.
Makes sense.
And he says you should always be critical when you're evaluating data sources.
Don't just trust everything you see.
Don't just take things at face value.
Do your own research.
Exact.
So it's about the quality of the data, not just the quantity.
And he also talks about how the time market's more volatile than some other major markets.
So that means you need to be more careful about slippage and transaction costs.
Right, because those things can really impact your profits.
And you need to think about those market events that aren't in the data.
Right, like political instability.
Oh, yeah.
Regulatory changes.
Things that are hard to predict.
So it seems like you need a really good understanding of the local context.
That makes sense.
To really trade in the Thai market.
And it's a good reminder that backtesting isn't just a one-size-fits-all approach.
Right. You have to adapt your methods.
The specific market.
So before we wrap up this part,
okay,
I want to talk about his views on the psychological aspects.
Oh, yeah. He talks a lot about that.
Because he says even with perfect backtesting, our emotions can still mess things up.
Because we're human. It's like you can have a perfect plan, but then you get scared or greedy.
Exactly.
And you make a bad decision.
So he says we need to develop discipline.
Yeah, emotional resilience.
To really execute our strategies.
It's not just about the numbers.
Right. It's about understanding yourself.
Yeah, knowing your weaknesses.
So we've covered a lot of ground.
A lot. Walk-forward analysis, the Thai market.
The psychology of it all.
Yeah, there's so much to learn.
But there's still more to come.
Oh, really?
In the final part, we're going to talk about his views on ruin.
Okay.
Which is a pretty intense topic.
Yeah.
But he has a really interesting take on it.
I'm intrigued.
And we'll also talk about his thoughts on optimization.
Okay.
And like relying too heavily on the software features.
Got it.
So stay tuned for all that and more.
I will.
Welcome back to the final part of our deep dive.
Oh, it's gone by so fast.
I know, right? We've learned so much already.
So much.
We talked about different backtesting methods, the Thai market.
All those pitfalls to avoid.
Yeah, and now I really want to hear what he has to say about ruin.
Oh, yeah, that's a scary word.
It is.
Especially for traders.
But he has a really interesting perspective on it.
Now,
he kind of expands the traditional definition.
So what does he say?
Well, traditionally, ruin is like losing all your money.
Right, going bankrupt.
But he says it can also be a really bad drawdown.
Okay.
That takes forever to recover from.
So you might not lose everything.
Right.
But you're stuck.
You're stuck in a hole.
For a long time.
Exactly. And he talks about like the psychological impact.
Yeah, because that can really mess with your head.
Right, and it can lead to bad decisions.
You start making emotional trades.
You panic.
Yeah.
And then there's also the opportunity cost.
Right.
Like your money's tied up.
You can't use it for something else.
It's like being stuck in traffic.
You're not getting where you need to go.
You're losing time.
Exactly.
So he recommends doing these ruin tests.
Ruin tests?
Yeah, so it's like trying to figure out the probability of those really bad drawdowns.
Oh.
Given your strategy and your risk management.
So you're not just waiting for it to happen.
Right. You're being proactive.
You're trying to quantify the risk.
And he even introduces this idea of time ruin.
Time ruin.
So your strategy might not actually lose money.
Okay.
But it could take a really long time to reach your goals.
Oh, so it's not worth it.
Exactly. Time is money.
That's a good point.
So we've talked about ruin, and now I want to talk about optimization.
Okay, go
because he has some thoughts on that too.
What does he say?
So he compares those optimization features in software to a magic wand.
Oh, like they're too good to be true.
Right. It's tempting to just tweak everything.
Yeah, get those perfect results.
But he says it can lead to overfitting.
Oh. So your strategy's too tailored to the data.
Exactly. It looks great on paper, but it doesn't work in the real world.
Yeah, it's like editing a photo too much.
It looks fake.
Exactly.
So you need to find that balance
Okay.
between optimizing and being realistic.
So it can handle those surprises.
Right, because the market's always going to throw you curveballs.
Yeah, you can't predict everything.
And he says backtesting software is a tool.
Not a crystal ball.
Exactly.
It can't tell you the future.
But it can give you insights.
Yeah.
And he also emphasizes human judgment.
Even with all the algorithms and automation.
Because trading is an art.
Not just a science.
So what's the big takeaway here? What should people remember?
Be critical.
Okay.
Don't just accept things at face value.
Question everything.
Dig deeper, do your own research.
It's an ongoing process.
Yeah, you're always learning and adapting.
And don't forget about the human element.
Your mindset, your discipline.
Those are key.
So go forth and backtest wisely.
Backtest wisely.
That's it.
That's a wrap for our deep dive into backtesting.
It was a good one.
I know, right? I learned a lot.
Me too.
So hopefully our listeners did too.
I hope so.
Until next time, happy trading.